2024 shocked everyone. Tech giants soared 40%. Trump's comeback bid shook markets, and AI demands pushed power grids to their limits. But here's what most investors missed. Certain ETFs quietly capitalized on all these trends, and they're positioned even better for 2025. Remember when everyone said growth stocks would crash with high interest rates? Or that small caps were dead? Well, the ETFs I'm about to show you prove them wrong. And with the market landscape shifting dramatically for 2025, from potential regulatory changes to the exploding AI infrastructure demands, these same ETFs are setting up for what could be an even bigger year. I'll be straight with you. I keep 30 to 40% of my portfolio in ETFs. Not because some financial advisor told me to, but because I've learned through years of investing that the right ETF picks can outperform even the hottest stock tips. And no, I'm not talking about basic S&P 500 exposure. You already know you need that. Today, we're diving into 5 ETFs that are riding the biggest trends of 2025. Massive tech transformation, the changing political landscape, and yes, the infrastructure powering the AI revolution. Each one serves a specific purpose, and by the end of this video, you'll understand exactly how they could fit into your strategy. Let's start with our first pick, an ETF that's outperforming 94% of its peers and just delivered its best year since inception. SCHE, the Schwab U.S. Large Cap Growth ETF. While everyone was panicking about interest rates crushing growth stocks, this ETF quietly surged 40% over the past 12 months. But here's why that number matters more than you think. It didn't just ride the AI wave. This ETF captured growth across multiple sectors, from healthcare breakthroughs to digital payment evolution. Now, you might be thinking, isn't 48% technology exposure too risky? Here's what most analysts miss. These aren't speculative tech plays. We're talking about companies like Microsoft and Apple, who are sitting on massive cash reserves and growing their dividends every year. In fact, the top 10 holdings, making up 56% of this ETF, generated over $200 billion in free cash flow last year alone. Let's break down exactly what you're getting. Beyond that 48% technology exposure, you're looking at 14% in consumer discretionary. Think Amazon's dominance in retail, 12% in communication services. Think Meta's advertising empire, 10% in healthcare, including breakthrough companies like Eli Lilly, and 7% in financials. This isn't just diversification. It's strategic exposure to the sectors leading the next wave of growth. Speaking of strategy, Warren Buffett himself has warned about over-diversification. You will hear people talk about combining S&P 500 funds with total market ETFs like VTI. But here's the reality. SCHG gives you concentrated exposure to the 229 companies that are actually driving market returns. With $37 billion in assets under management, this isn't some experimental fund. It's a powerhouse that's positioned perfectly for 2025's market dynamics. Next up is SCHD, the Schwab U.S. Dividend Equity ETF. If you've been watching in frustration as tech stocks stole all the headlines, this ETF deserves your attention. While everyone's chasing the next AI breakthrough, SCHD has been quietly building generational wealth through a strategy that's weathered every market storm since its inception. Here's what makes SCHD different. It's not just another high-yield trap. With $64 billion in assets under management, it's mastered a balancing act that most dividend ETFs get wrong. When most high-yield ETFs were cutting dividends during market stress, SCHD was raising them. When dividend growth funds were sacrificing current yield for future promises, SCHD was delivering both. Now, you might be looking at its 10% return over the past 12 months and thinking, that's not impressive compared to tech returns. But here's what makes this number fascinating. SCHD achieved this despite the biggest market rotation we've seen in years. Even after the recent sell-off, it's trading at August levels, giving you a rare second chance at an entry point that institutional investors are already moving on. Let's talk about what's actually in this ETF, because this is where it gets interesting. Unlike the tech-heavy market indices, SCHD's top sectors tell a different story. 20% in financials, 15% in healthcare, 14% in consumer staples, 12% in energy, and 11% in industrials. Technology, just 10%. This isn't by accident. It's a deliberate strategy to tap into sectors with strong cash flows and pricing power. Look at the top holdings. Cisco Systems, BlackRock, Bristol-Myers Squibb, Home Depot, Chevron. These aren't just dividend payers. They're dividend growers with moats around their businesses. Each position is capped at just over 4%, with 103 total holdings, creating a balance that's hard to find in other dividend ETFs. And with quarterly rebalancing and an annual reconstitution every March, it stays current with market dynamics. Here's what really sets it apart. While everyone's worried about tech concentration risk, SCHD gives you exposure to the parts of the economy that actually benefit from rising rates. And it does all this with a mere 0.06% expense ratio. Think about that. World-class dividend growth at a cost that's lower than most basic index funds. Before I reveal our next ETF, let me show you something that might shock you. If you had put $100,000 equally into just SCHG and SCHD 1 year ago, here's what would have happened. Our growth powerhouse turned its $50,000 into $70,000 with that remarkable 40% return. That's a $20,000 gain from just one position. Meanwhile, SCHG added stability and additional returns, growing its $50,000 to $55,000 with a solid 10% return, contributing another $5,000 to our profits. Look at the final value distribution in the pie chart. That's a $25,000 gain in just 1 year. And remember, this was during a period when everyone was panicking about bank collapses and recession fears. But here's the twist. What I'm about to show you could potentially outperform even this combination. Because while everyone's focused on large caps and dividends, they're completely missing what's happening in the small cap space. In fact, there's a historical pattern that almost nobody is talking about, one that's setting up perfectly for 2025. This pattern has everything to do with our third ETF, IJR, the iShares Small Cap ETF. With $87 billion under management, it's captured something remarkable. Small caps historically surge not during political promises, but during actual regulatory changes. And 2025 could be the perfect storm. Let me break this down. In the last decade, small caps have consistently underperformed the broader market. But here's what makes this fascinating. It's not because these companies are weak. It's because they've been suffocating under regulatory costs that eat up to 30% of their profits. Large caps can absorb these costs. Small caps? They've been fighting with one hand tied behind their back. This is where IJR's strategy becomes brilliant. Instead of spreading bets across thousands of small caps, like its competitor IWM does, IJR laser focuses on the top 600 small caps. We're talking about companies already gaining momentum toward mid-cap status. Names like Bath & Body Works, Alaska Air, and Robert Half. Companies with real revenue, real profits, and real potential to explode when regulations ease. The fund's 10% return over the past year might not look impressive after what I just showed you with SCHG and SCHD. But that's exactly why the timing for 2025 is perfect. We're getting in before the regulatory catalyst, not after. And with a tiny 0.06% expense ratio, we're paying index fund prices for what could be the next major market rotation. Quick pause here. If you found value in our research so far, do me a quick favor and hit that like button. My team spends countless hours analyzing market data and running these numbers. And while this information is completely free for you, your response helps us reach more investors like yourself. Now, let me show you something that shocked even our research team. Everyone's obsessed with AI stocks right now. But here's what the smart money knows. AI is just a shiny surface. The real gold mine, it's in protecting all of that AI infrastructure. Think about it. Every AI model, every data center, and every corporate AI implementation needs one critical thing: cybersecurity. This brings us to iHack, the iShares Cybersecurity and Tech ETF. And before you dismiss this as just another tech fund, consider this. While AI companies are burning cash to develop their models, cybersecurity companies are sitting on profit margins that would make even Warren Buffett smile. With $915 million in assets, iHack might look small compared to our previous ETFs. But that's exactly what makes this opportunity so interesting. Institutional investors haven't piled in yet. Despite the daily headlines about cyber attacks, despite the billions companies are spending on protection, this sector is still flying under most investors' radar. Let's look at what you're actually buying here. The top holdings read like a who's who of cyber defense. Fortinet, SentinelOne, Palo Alto Networks. But here's what makes these companies different from typical tech stocks. They don't need to convince customers to buy. Every company, from the smallest startup to the largest bank, already knows they need cybersecurity. It's not a luxury anymore. It's as essential as electricity. Over the past 12 months, the fund has returned about 10%. Sounds modest? Well, that's because most investors are missing the bigger picture. While everyone's focused on who's going to build the next ChatGPT, these companies are quietly securing the entire digital economy. And with only 46 holdings, this ETF is laser-focused on the best players in the space. The last ETF on our list is XLU, the Select Sector SPDR Utilities ETF. Before you roll your eyes at a utilities ETF, let me show you something fascinating. During Trump's first term, utilities quietly surged more than 30%. But here's why 2025 could be even bigger. The AI boom isn't just straining our power grids, it's transforming them. You see, single ChatGPT-style AI training run consumes enough electricity to power 15,000 American homes for a year. Microsoft is building AI data centers in 15 different locations. Google, 23 locations. Meta, they're not even telling us how many. And guess who holds the keys to powering all of this? The companies in XLU. This $16 billion ETF isn't just a defensive play anymore. Look at its largest holding, NextEra Energy. Everyone thinks they're just another utility company, but they're quietly becoming the backbone of America's AI infrastructure. They're not just providing power. They're building the next generation of energy systems specifically designed for massive AI operations. The fund structure is beautiful in its simplicity. 34 companies, with the top 10 making up 55% of the portfolio. We're talking about companies like Southern Company, Duke Energy, and Constellation. They're not sexy names, but they have something better. They're literally the only companies legally allowed to power these massive AI operations in their territories. XLU is already up 23% in the past 12 months, but here's why 2025 could be its breakout year. AI power demand is projected to double every 6 months. Double. Think about that. And with a tiny 0.09% expense ratio, you're getting exposure to this entire AI infrastructure play for practically nothing. That's it for this video. I'll see you in the next one.